From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. 30 minutes away from the start of trading on Wall Street, you're seeing basically a range-bound market, although crude very much leading the charge. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Coming up, oil prices rising after Saudi Arabia's July production cuts. Big U.S. banks could face a 20% jump in capital requirements as Apple shares inch towards a record high ahead of its developers conference. We begin with a big issue on the cusp of another bull market.
Fear pivot to FOMO.
Equities have trading optimistic.
You're seeing markets move higher.
Equity market participants are very lucky.
The U.S. consumer has been strong.
We had the Q1 earnings results. Corporate America is actually doing all right.
The economy really hasn't slowed much at all.
The U.S. has been more resilient than anticipated.
The data, the economic surprise continues to be so resilient.
The U.S. is in a very different place.
American exceptionalism.
The U.S. economy remains a major engine of job creation.
All of this debt ceiling uncertainty.
A debt deal
removes it as an issue for the next over a year and a half.
The Fed, they got into the game late.
Skip, a pause, or hike. It certainly complicates it.
I don't think we rule out a 25 basis point hike in June.
I don't see any evidence for rate cuts.
A skip, not a permanent pause.
The Fed raises rates one or two more times.
Plenty of reasons to keep on hiking.
The Fed is going to have to make a really difficult judgment.
If this is a new bull market, it is one that people really dislike. Joining us now to discuss, John Hancock's Matt Miskin and Krishna Mamani of Lafayette College. And this is what strikes me. If this is the start of a new bull market, people do not like it. Matt, do you think that it is accurate to say that we are on the brink of a new kind of economic cycle that is starting to rear its head?
We do not believe so. We think we're in a late cycle environment where you're in this choppy trading range across asset right now, and you're getting this better than expected data, worse than expected data. It's all coming in relative to expectations, and whether or not it's beating expectations, market like it. If it's not, then the other side of the coin. Right now, fighting the tape is like fighting Mike Tyson, and it is a challenging backdrop to be relatively conservative in a late cycle environment. We're tilting toward the higher quality parts of markets, holding on here until we see more clear signal of a recession on our doorstep. We're not there yet. But for us, managing risk is a top priority.
Krishna, do you agree? Is it like fighting Mike Tyson and yet you need to stick with it?
Well, I think it's fighting imaginary Mike Tyson in a way. That is, people have been looking for this recession bugaboo for quite some time, and it really hasn't materialized. That in and of itself doesn't really mean that this is the start of a new bull market. I think if you kind of boil things down, it comes down to two things. Nominal growth is too high for stocks to tank, and rates are too high there's not enough slowdown in the economy for it to be a real start of a bull market. It may actually come about that way, but I think looking at the data today, making that assertion on both sides just doesn't hold. We are in a choppy market, range-bound market, and we'll try to break out. And if we do, and the economy remains where it is, we will probably give a lot of that back at some point later this year.
A choppy fog fighting a fake Mike Tyson. I love it. Happy Monday. Meanwhile, we do have on one side, perhaps it's a bull market. On the other side, you have Morgan Stanley's Mike Wilson, who's expecting a sudden pullback in corporate earnings to slam the brakes in the recent U.S. equity rally, writing, quote, hotter but shorter cycles persist. We continue to forecast an earnings recession this year that we don't think is priced, followed by a sharp EPS rebound in 2024, 2025. We recommend investors focus on stocks with defensive characteristics, operational efficiency, and earnings stability. That seems to be, Matt, what you were saying. There is this real kind of dilemma here. You can say we're not entering a new bull market, but can you get bearish? Can you fully rule out some of the areas that have gotten pretty beaten up and say they're not perhaps trying to yield a little bit more value here?
Yeah, I mean, for us, the value, for example, like financials right now, I mean, you're seeing the higher cost of capital really weighing in, the lending growth decelerate, but the solvency risk diminish. So that jobs report on Friday, and what a week last week. I mean, you got the ISM new orders index coming in below expectations, 42. So leading indicators still showing a slowdown. And then you got coincident data like the jobs report beat and causing a massive rally in these financial sector in some of these cheaper parts of the market. We would trim into strength, redeploy that capital into higher quality companies, great balance sheets, good ROE, things like that. And what we see in terms of earnings estimates, to Mike's point, is that in the back half, earnings estimates really ramp up. So it's nice in Q1 and Q2 that the estimates are negative 6% earnings growth, and you could come in better than that. But in the back half, the street is looking for a nice earnings recovery and inflection point. That's where the bar goes up, and it's going to be harder to beat. So we're looking for those that have lower estimates. Tech and healthcare have flat to negative earnings estimates. Those two places we think could actually beat on the upside over the year.
Krishna, do you agree that some of these areas are actually starting to see perhaps the greener shoots than other areas that have gotten bid up perhaps a bit more?
Absolutely. So I think people focus on the narrowness of the market and why the kind of the temporary breakout that we have cannot be sustained. I think if you look broadly, again at a macro level, the most cyclical part of the economy, housing and construction, is not slowing down. If there was going to be a recession or really an earnings recession, you have to see some evidence somewhere. And we added 340,000 jobs. So we can look at any piece of data and convince ourselves of any view that we have. But if you look at the underlying strength in the economy, it is just extraordinarily strong. Not something that anybody could have expected at this point with the Fed raising 500 basis points in rates. But it is what it is. And expecting a recession and an earnings recession in this context, it seems a little less likely in my view.
Some of the areas that perhaps have been sending a contrary signal has been the oil markets, which did get bid off quite significantly, sold off quite significantly. And now oil is advancing up about 2.5% plus or minus after Saudi Arabia pledged to cut 1 million barrels a day from its production starting next month. This was at the Vienna-based OPEC Plus meeting. Joining us now from there is Bloomberg's Manis Cranny. Manis, what did we learn, and how much is this pop that we're seeing in prices likely to stick?
I think it's going to be tricky because I remember days when 1 million really meant something. Here we are. Let me give you a fresh line. The Saudi minister's just done another interview. His Royal Highness Prince Abdulaziz bin Salman. Talk about a good night's sleep and reflection. The Saudi minister says he's fed up with OPEC members not meeting their output goals, and says the Saudis will seek more transparency from Russia. So here we had the sugar rush from the lollipop, up 4% on the open, gave a little bit back. The market reflects this is a real cut, make no doubt about it. It's almost twice the size of everything that you've seen before in the past 8 months. So just put that in the back of your mind. To me, that creates the floor. That creates the near-term floor in this market because he's bought himself a call option, the ability to roll this cut forward, forward, forward. Coming into this, there were 3 dreams. The economic dream of Saudi Arabia, the war that Russia is lording over Ukraine, and third, the Emiratis wanted a higher production target. We've just worked it out. You gave up 1 million barrels a day for a month on a rolling basis, $2.25 billion. The dream suffers. It matters to keep this floor in place, and perhaps the upside can be retested if the Chinese reopening is delivered. But we have a global manufacturing slump. You've done the data. These are breaking headlines from His Royal Highness Prince Abdulaziz bin Salman. A good night's sleep just shows you what a bit of reflection does. They want more, and they want more transparency from Russia.
How much is the cut some sort of signal as to what Saudi Arabia sees from China? And this is something that we were talking about with Ellen Wald earlier, this question around, do they know something that we don't with respect to cutting production even further?
Look, I think we've got to, sometimes you just got to stand back from this from a moment and go, every PMI that you've read out there, that I read out in the morning in the Middle East, that my colleagues read out in Europe, we have a global manufacturing recession. That is factual. Everything else that we're debating around the margins about hot employment, hot wages, etc., is about whether and when this recession slowdown comes. One thing I will say about this leader of OPEC His Royal Highness Prince Abdulaziz bin Salman. He sees himself as this central banker of oil. He channels his inner Greenspan. He wants to be ahead of the macro. He wants to present himself as somebody that has the finger on the pulse. So to that extent, maybe there is something more malevolent. I'll leave you with this thought. The Saudis raised prices on selling their crude to Asia last month, despite the drop from China. 900,000 barrels a day down last month in terms of demand. But they raised their pricing. They are trying to balance this. This is about the economic dream of Saudi Arabia and delivering that transformation program that his brother, who runs the country, MBS, is in charge. So that is the driver, and it is about trying to be ahead of the macro.
Right now we're looking at Manus Credi. Thank you so much. As we're speaking with Manus Credi, we're looking at European gas futures jumping 20% on expectations of more Asia demand. This crossing the headline, the terminal as a hot headline. And I do wonder how much this is going to feature into expectations for inflation. Around the same time, we're also getting word from the ECB president, Christine Lagarde, saying no clear evidence that underlying inflation has peaked and that the ECB is fully committed to fighting inflation. Still with us, Krishna Mamani as well as Matt Miskin. Krishna, from your vantage point, how much do you think that people have underpriced some of the inflationary inputs from the likes of natural gas, certainly in Europe, as well as higher oil prices?
No, as the person speaking before me was indicating, I think if you kind of look outside the U.S., we are in a slowdown, and I think that is entirely factual. And I think that is the driver of oil prices and natural gas, and inflation expectations driven by commodities, far more than what is happening in the U.S. So I think the point is entirely correct. That is, the attempt of Saudi Arabia to cut production is really getting ahead of a slowdown rather than meaningfully trying to raise prices in an environment where that cannot be sustained, especially given what the outlook is in the rest of the global economy.
Matt, do you think that oil is still an indicator in terms of global growth, or do you think that right now it's kind of lost the signal and the noise just simply because of all the distortions and the varying inputs from China and the cuts and the production sort of ambiguity out of Russia?
We do. And, really coming into this morning, what did we get? We get higher gas prices. So that's not good for the consumer. Interest rates are higher because inflation expectations are higher. That means higher cost of capital. That's not a great sign. And then the dollar's stronger, which the dollar is now more correlated to oil than it was in the past because the U.S. is such a big exporter. But all those three things are not good for the consumer or the macro, frankly. So we, again, think we're in a late cycle environment where you're getting this tightening through these channels, which eventually it works with a lagged impact. And I think that's the biggest misconception right now, or the thing that's missed, is that monetary policy works with a lag. So when you hear everybody saying everything's great, soft landing, we still haven't felt the lagged impact of a lot of this tightening that's coming through. And now OPEC's trying to push in a little bit more tightening right now. That, unfortunately, is going to have more of a negative impact in terms of the consumer.
Matt Miskin, Krishna Mamani, both of you are sticking with us, which we're really pleased about. Joining us now, let's take a look at which stocks are moving ahead of the opening bell. Abigail Doolittle. Abby.
Lisa, let's start out with the shares of Apple because they are popping higher. Potentially, if they were to close at this level, after they open at this level, it would be a record closing high for the shares and not so far away from a potential intraday high. This, of course, is the Worldwide Developers Conference is occurring today. Updates on all kinds of platforms and the excitement it generates. This stock now up about 40% on the year. Tesla also higher, 1.7% positive news out of China. They sold more than 77,000 made in China vehicles last month and sold nearly 76,000 in China, a 142% jump from the year prior. And then AI, Lisa, not so much today. We have shares of NVIDIA down 1.2%. Palantir, most stocks related to AI, taking a little bit of a breather after the big rally that we had last week and the week before.
I like that you say that. A little bit of a breather, down 1% isn't exactly a massive rout. Abby, thank you so much. Coming up, one crisis averted down in D.C.
It was critical to reach an agreement. And it's very good news for the American people. No one got everything they wanted, but the American people got what they needed.
Curtains closing on the debt limit showdown. Markets now bracing for a flood of U.S. debt sales. More on that next. This is Bloomberg.
was critical to reach an agreement. And it's very good news for the American people. No one got everything they wanted, but the American people got what they needed. We averted an economic crisis, an economic collapse. We're cutting spending and bringing the deficits down at the same time.
Washington closing the books on weeks of tumultuous debt limit negotiations. Focus now turning to issues abroad at Asia's largest security conference. Pentagon Chief Lloyd Austin saying in a speech at the Shangri-La Dialogue, quote, "I'm deeply concerned that China has been unwilling to engage more seriously on better mechanisms for crisis management between our two militaries." His Chinese counterpart firing back, accusing, quote, "some big power of bullying other nations," telling the U.S. to, quote, "mind your own business." This coming as China says its Navy tracked U.S. and Canadian vessels throughout the Taiwan Strait over the weekend. Let's bring in the team down in Washington, D.C. Bloomberg's Emery Hordern and Kaylee Lyons joining us now. Emery, let's start with you with respect to some of those tensions. What did we learn? How much did we actually not ease some of the tensions, but ratchet them up at the Shangri-La Dialogue?
Well, there really was just this cordial handshake, and that's what Lloyd Austin described it. And then when he got up to talk about it, and this is, of course, with his counterpart in China, the Chinese Defense Minister Li Shangfu, and when he got up to talk about it, he said, we cannot just have these cordial handshake. We need dialogue. The issue, of course, Lisa, and this is something I asked the president about at the G7, is that Li Shangfu is under sanctions from the United States. This has to do with transport of Russian military equipment that he oversaw in 2018. And it was under discussion that the administration potentially lift those sanctions because that looked like a big barrier in the way for China to saying they would agree to sit down with Lloyd Austin, but they didn't. So all we got from these two leaders in terms of engagement at this Shangri-La Dialogue is just a handshake, and that's all. And the rhetoric was just amped up even more. And as you say, all of this with the backdrop of a Chinese vessel coming very close to a U.S. military warship that was going through the Taiwan Strait. Everyone else at this summit is just looking around and saying, we want to see these two economies engaging, and they're not. And they are quite concerned of potentially what this could lead. Many saying they do not want to see what is happening right now in Europe with Russia's invasion of Ukraine taking place in the Asia-Pacific.
That's on the international side. On the domestic side, Kaylee, there's a real concern. Yes, great, yay, we've got a debt ceiling agreement, but we now have to issue about net $1 trillion of T-bills in order to finance the government going forward starting this week. How concerned are people about the amount of liquidity sucked out of the market to pay for that?
Well, frankly, Lisa, here in Washington, I think so much focus was just put on the idea that the U.S. cannot default on its debt, getting a deal done and signed by the president, as we saw this weekend, less so about the ramifications of that, because avoiding default does mean, as you allude to, that the Treasury is open to borrow once again and is going to have to do so aggressively, considering that its cash balance has fallen below $23 billion as of June 1st. So in order to replenish those coffers, it is going to need to issue potentially $1 trillion or more of debt by the end of the third quarter. Just an absolute tidal wave of issuance that Bank of America has actually said could have the same consequence in terms of liquidity and economic implications as another quarter-point hike from the Federal Reserve. So we have to consider that. And then also the other ongoing risk at play here is that even though you have lifted the debt ceiling, put the risk of default on the back burner for another 2 years. We won't have to deal with it until 2025. Come the fall of this year, we still are going to have to pass a budget for fiscal year 2024 by the end of September. And there is a non-zero risk, according to Bank of America, of a government shutdown in October 1st, as we're likely to still see jockeying around that. So it's not to say that all the domestic issues, Lisa, are tied up nicely in a neat bow, even though we do have a higher debt ceiling now.
Kaylee and Marie, both of you, thank you so much for being with us. Still with us is Matt Miskin and Krishna Mamani. And I am wondering, Krishna, do you think that it is overplayed or underplayed, the amount of liquidity that would get sucked out of the system to pay for the net $1 trillion of T-bills the U.S. is expected to issue in short order?
So I think in an environment where the Fed is paying interest on excess reserves and you have more than $2 trillion in RRPs just sitting there, I think there is a way to kind of make it all work without it being disruptive at all. In fact, if all that happens is money comes out of RRP and goes into T-bills, nobody would notice it except for the Fed balance sheet. So I think this liquidity bugaboo is, again, another thing, a fake Mike Tyson being invented to kind of support a particular case. I think there will be some liquidity impact, but it won't be to the extent that people are making it out to be.
Krishna, just real quick before we get to Matt, are you getting full bullish? I mean, are you going full bull at this point?
No, not at all. I think, again, if there was some slowdown in the labor market, I would get bullish because that would mean that the Fed policy is having a meaningful impact. It isn't. So what I'm afraid of is we are, the Fed may have to do more. I'm hoping that is not the case, but that cannot be ruled out just yet.
Matt, your perspective on the T-bill issuance and what the implication is for the market. Is it a fake Mike Tyson?
Yeah, we do think it's a bit overblown, but what we're seeing is just tail risks keep getting chopped off. And that is the bullish argument right now, to Krishna's point, in essence, is that you keep getting these, big macro risks like the debt ceiling. And then, we come over these things and the wall of worry just keeps getting overtaken. And that is the bullish argument. To us, though, again, the labor market is tight. The Fed is tight. Liquidity is draining. Regardless, we're in a late cycle environment. The economy has held up until now. But again, the leading economic indicators are not giving the all clear sign. It's not like the yield curve is uninverted. It hasn't. It's massively inverted still. There's only one way the yield curve uninverts, and that's usually, historically speaking, the Fed to cut rates. I know that now it seems like that's not going to happen, but eventually it likely has to happen.
Just real quick, Matt, 20 seconds. How much are you looking at credit really expressing the risks that you're seeing?
Yeah, tightening of lending standards, higher cost of capital, all that will weigh on the economy in time. Again, getting a bit more defensive into this risk-on rally may make some sense.
Matt Mishkin and Krishna Mamani, both of you, thank you so much for being with us. Coming up, the morning calls, and later, Joanne Feeney of Advisors Capital Management joining us with her outlook for stocks as they edge even closer to bull market territory. That conversation still ahead at the opening bell. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, KeyBank downgrading target to sector weight, expecting the resumption of student loan payments to weigh on consumers. Next up, Morgan Stanley downgrading Dollar General to equal weight, seeing too many macro uncertainties. And finally, Citi upgrading Ford to buy, pointing to the stock's valuation and strengthening demand. Coming up, the opening bell. We'll get that to you with Joanne Feeney of Advisors Capital Management. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. A moment away from the start of trading, what you can see is there has been this shift upward in the S&P, up about 0.1%, even as you see a little bit of a decline in the NASDAQ. Meanwhile, the Russell continuing to underperform, down 0.3%. In the yield space, you are seeing yields marginally higher as people assess what the strong labor market report on Friday means for the Federal Reserve. We could see the 10-year yield a little off earlier highs, 3.74%. Euro weakness, dollar strength, 106.85. And crude markedly higher after Saudi Arabia agreed to cut output by 1 million barrels per day, after they did not get any kind of commensurate agreement from United Arab Emirates. One stock to watch at the open is Apple. Shares climbing above its record close level, inching closer to a historic $3 trillion valuation. Abigail Doolittle has more. Abby, what will drive us to that valuation?
Well, the Worldwide Developers Conference today is certainly a piece of it, the excitement for what might be unveiled. But what's so interesting about this, Lisa, it feels a little bit like a stealth rally to me, because this stock now up 40% on the year. It's best year since 2020. Of course, after falling 27% last year. And now we have the stock basically at a new all-time high, very close to an intraday record high. But if it holds these levels into the close, it will be a record close. Investors, I think, Lisa, looking forward to next year, because this year we're actually modeled for negative growth on both the top and the bottom line. If you recall, a few years ago, back in 2016, when we had the first time of revenues dropping in about 10 years, it was a big deal. The stock fell a lot. Well, that could have been why the stock fell fell so much last year. Next year, we're looking for 9% bottom line growth. We're looking for top line growth as well. Anything could happen to those estimates, but I think that that's one piece of what's driving this stock higher on the day and on the year, Lisa.
I believe our team here has said $190 per share would bring it to that $3 trillion valuation. Abigail, thank you so much. From big tech to big oil, energy stocks getting a boost after Saudi Arabia's surprise production cut. Its energy minister saying that he would, quote, do whatever is necessary to bring stability to the market. Stability means higher prices. Katie Greifeld joining us now with more. Katie.
And that stability, definitely a windfall for some of these energy equities, at least for today. You have the likes of Chevron, Exxon, both rallying from the bell. Not quite as much as oil itself, but still a rally nonetheless after, of course, that surprise production cut from Saudi Arabia. Now, Jefferies analysts had a really interesting note out this morning saying that this is definitely positive at the margin for oil and for these equities, but longer term, it's still demand that's still the driving force for this market. So we'll see how long the legs are on some of these gains, but still it's a needed win for a sector that's really struggled so far in 2023. That's after absolutely crushing it the past couple years. Energy was the best performer for 2 straight years. It's the biggest loser this year, though, as demand has ebbed. It's down almost 8% or so far this year. That follows a gain of 59% in 2022, Lisa.
Katie Greifeld, thank you so much. Turning now to the financials, big U.S. banks potentially facing a 20% increase in capital requirements. That's according to reporting earlier this morning from the Wall Street Journal. Let's bring in Bloomberg's Kaylee Lines for more. Kaylee, what's the logic and the likelihood behind this potential capital raise?
Well, Lisa, frankly, we knew something like this was likely coming. The Fed already had been undertaking a holistic review of capital requirements under the Vice Chair of Supervision, Michael Barr, and that was before we saw multiple banks fail earlier this year, which really put an increased scrutiny on regulators and the prudential regulation of banks, specifically between $100 and $250 billion in assets. That saw some of those requirements rolled back under the Trump administration with the 2018 changes to how Dodd-Frank applied to banks of those size. And Michael Barr had hinted in the Fed's report put out after the failure of Silicon Valley Bank that may mean that things need to be tightened, and we could actually see those proposals soon, Lisa. The Wall Street Journal reporting potentially as early as this month. We could see an average 20% increase to the capital requirements of larger banks and banks with at least $100 billion in assets rather than the current threshold of $250 billion could be subject to those same rules. Now, of course, we're likely to see some pushback on this from the banks themselves, especially the larger ones. The 6 biggest, mind you, have built $200 billion more in their capital reserves over the last decade. And you may see political pushback as well. Of course, one side of the aisle on Capitol Hill has pushed back against the idea of doing anything legislatively to heighten regulation in the banks even after the failures. But this would be regulators acting really with their existing authority. So we'll wait to see what those rules potentially are, Lisa. But you are seeing the financial sector as a whole lagging early on in the trade today.
Kaylee Lines, thank you so much. Joining us now is Joanne Feeney of Advisors Capital Management. Joanne, as we speak, we're seeing Apple shares climb to a new intraday all-time high ahead of their worldwide developers conference. This really comes as people have already rallied around these shares, up about 40% year to date. Question around how much this can continue. Joanne, from your vantage point, does big tech still have steam?
Yeah, good morning, Lisa. You know, there's a lot of future opportunity available for these big tech guys. The Super 7 has really driven the market up so far this year, comes on the heels of new information about the potential of AI. And what we saw was investors reevaluate the future earnings potential of these companies. And Apple may not be as thoroughly involved in AI as some of the others, but I think it's clear to investors that Apple has a stranglehold on the folks that use the iPhone and the other parts of the Apple network, because it's just so, once you're in for a. We've seen a lot of institutional investors start to increase their positions because they were underweight a lot of these big names. I think that's driven a lot of the rally so far. But looking longer term, we think there's a lot more room to go. However, given the recent rally, we probably shouldn't expect as much from these companies over the next, several months.
Have we moved away officially from them being interest rate sensitive?
No, not at all. I think what we saw last year, right, was the digestion of the higher interest rates on these valuations. And what we're seeing now is the reflection on the higher growth coming for them. And moreover, Lisa, right, we are expecting the Fed to pause probably here next week. And that means that interest rates going forward are, flat-ish to coming down over time. And that means that interest rates actually become a tailwind. And I think investors are also, reflecting that when they buy these names now.
Okay, this is what I'm actually struggling with this morning. Yes, people are waiting for the next bull market. They're looking for reasons to buy. They're looking for reasons to not be bearish anymore. And yet we still have a Fed that isn't quite on hold. Maybe they're not going to raise rates next week, but they certainly have a labor market that still is incredibly hot. How do we get from there to rate cuts in the time frame that this market is currently pricing in?
Yeah, Lisa, I think that conundrum that you just described is exactly the problem. The Fed has still a lot of work to do to get inflation down. And that means that, investors should be prepared for things to probably be a little bit boring here, because probably see a pause. We're probably not going to see any rate cuts this year, although the market is expecting that, because that inflation problem is so intractable. And what we're seeing in the labor market suggests that the economy is still quite strong. Labor is still much in demand, and wages are still rising over, close to 4.5%. That's not a recipe for getting inflation down quickly. So it's going to take some time, and we probably aren't going to see rate cuts till next year. But the flattening of interest rate, that path of interest rates, is what I think has taken the headwinds away from the higher valuation technology and growth companies.
As we shift from tech to the rest of the universe of equities and beyond, just in terms of what hasn't followed through with the rally to the same degree that the Apples and the Metas of the world has, we have to turn back to oil and this idea that Saudi Arabia is concerned enough about how low prices are that they are making a unilateral 1 million barrel per day cut in production. How much does that give you faith that there is some more value in some of the equity names that haven't really done so well?
Lisa, this has been a really frustrating time for a lot of investors because they see these big tech names going up. And if they're diversified more broadly, across the market, looking at some of the longer growth potential, they're not seeing as much of a lift to their portfolios. We're getting a lot of questions from our clients saying, is this a time to be going into equities given how much the market so-called has risen? And the market really hasn't risen. It's two markets. It's the Super 7, and then it's the rest of the market, which has barely budged. And, I think that investors need to be patient here and recognize there are still opportunities because the rest of the market really hasn't gone up that much because of these recession fears, because of the concerns about what the Fed is going to do. But longer term, we're seeing the infrastructure bill, the Inflation Reduction Act. There's good government spending going on to support various manufacturing industries. There's a real opportunity here among those names that really haven't moved much this year.
How much are you shifting out of bonds and into equities? And I ask because Mark Heffley of UBS doesn't seem to have much faith in the recent equity rally, writing, quote, we continue to prefer bonds in our equities in our global strategy, favoring defensive, higher quality segments of fixed income as they offer both attractive absolute yields and a hedge against growth and financial stability risks. Do you agree with that, or is that not really working given that a lot of the stocks that are out there have not participated in the gains so far this year?
Yeah, well, the bond side of a client's portfolio can do very well in this environment. They're getting terrific yields, although over the long term, those yields are wonderful for a bit of cash flow, but they're really not keeping up with inflation so much. So for long-term appreciation in portfolios, you still need to be in equities. And there are ways to be in equities that are defensive too. You can buy, higher dividend yielding stocks. Some of our balanced strategies are putting up, 4 or 5% dividend yields, and you get some total return over time with appreciation as some of these stocks that haven't performed well start to recover, as some of these recession fears, potentially fade, and as some of those government spending programs help to boost, the industrial companies, for example.
How are you positioned in terms of bonds versus stocks right now?
It's up to the client, Lisa. I mean, it's really up to them and their risk preferences and their time horizon, right? So somebody pre-retirement may be more heavily, 80-20 equity to fix. Somebody in retirement that, really needs to have a better handle on a more stable portfolio is going to be more, potentially 30-70 or 40-60. So it really depends on the client, their time horizon, and their risk tolerance to determine that. But total return and appreciation of the portfolio is still going to come from the equity side. And if you have a sufficiently long horizon, I'm talking, 3-5 years, it's not a bad time to be more broadly exposed to equities.
Let's say your client brings to you Morgan Stanley's Mike Wilson and some of his recent research, where he said, quote, the boom-bust period that began in 2020 is currently in the bust part of the earnings cycle, a dynamic that's not yet priced in our view. And what happens if they say to you, there will be a better entry point? What do you say?
I say, excluding those Super 7 that have done so well, the entry point is probably really pretty good right now in equities. And, for the investor that has a 3 to 5 year time horizon, the boom bust cycle happened last year. we saw that major pullback. We saw those recession fears come in, the global geopolitical risks come in. Now we're starting to see investors look beyond the recession risks, seeing that strong labor market. Yes, we might get a recession. We're probably thinking it's going to be next year and it's going to be mild. But, the investors should be looking longer term than that. And there's some really good opportunities out there, stocks trading still below 15, 16 times that have good long-term potential. So this isn't a time to avoid equities, but it is a time to pick and choose. That's why we only own, 40 to 50 stocks in a client portfolio, so we can be pretty selective at this point.
Joanne Feeney, thank you so much for being with us. Coming up, shares of Apple hovering at record highs, hitting them on an intraday level ahead of its developers conference. We'll look ahead to the big event in Cupertino with D.A. Davidson's Tom Forte. That conversation coming up next.
AI adds another $30 to $40 per share to the Apple story. From a user perspective, be giving users the ability to, on the services side, from cloud, from music, from TV, to more and more of the devices, cross-pollinating between different devices that you're going to be able to get different information within the actual Apple user. And I think what Cook's going to talk about is AI could be really another foundation, another monetization of the Cupertino growth story.
And that monetization has led to about a 40% pop in Apple shares so far this year. New all-time highs on an intraday basis for those shares. And the S&P, this has really helped to fuel the fact the S&P 500 has now risen 20% from the October low, set to enter a bull market, except only with 7 stocks, evidently, with big tech leading the charge, which is the reason why investors are so focused, so trained on the Apple's Worldwide Developers Conference, which happens today. Shares have been hitting all-time highs. People expecting the tech giant to unveil a mixed reality headset that could potentially help fuel future growth. Joining us now is Bloomberg's Caroline Hyde with more. Caroline, what are we looking for today?
All about the headset. Yes, you're going to get a sprinkling of operating system upgrades. You're going to see that for the watch. You're going to see that for the Macs, maybe a new lineup of a Mac. But really, ultimately, Lisa, this is about VR, AR. This is about a headset that's going to be selling at about $3,000. They're not thinking of selling many, about 900,000 in the first year. Just compare that to the, 200 million that they send in terms of overall iPhones per year. But this is a focus on reinventing what basically Meta hasn't really been able to make a killer product. The fact that it's going to be lighter weight, aluminium, carbon, graphite, the likes of glass going to be going into this. Initially, Tim Cook thought this was going to be sort of like a pair of glasses you'd be able to wear all day. It's not that. It's like ski goggles, more like. But this is going to reinvent the wheel. This is going to be aspirational. And this is going to be something that they hope is going to be productivity-led, gaming-led, health-led as well.
Caroline Hyde, thank you so much. D.A. Davidson analyst Tom Forte commenting on Apple's expected AR headset launch that Caroline was just talking about, saying, quote, this could represent its most significant new product launch since the iPhone and the biggest new product launch during Tim Cook's tenure as CEO. Tom Forte joins us now. Tom, can you talk about why it's so significant if at first they're not going to roll it out in so much scope in terms of the number of units sold, and it's going to have a pretty high price tag of about $3,000?
Yeah, those are excellent points. And the way that I think about it is when you go back to 2007, when they released the iPhone, the real power of the iPhone came with the apps and the App Store. So I think it's excellent that they're going to launch an AR/VR headset. And I do believe this is potentially by far the most significant new product news during Tim Cook's tenure, but it's going to take time. There needs to be content. There needs to be things that people can use when they use this augmented reality, virtual reality headset. But I think it's exciting as it is the most significant product launch in a long time.
How do you value some of these names that have gotten bid up so dramatically? I mean, I think of NVIDIA as sort of a front runner in that game, but Apple as well. How do you give a valuation to something at a time when a lot of people thought that you'd already brought forward a lot of the growth in the pandemic, and suddenly we're looking at a new wave from AI, a new wave from new innovations?
When Apple trades at an all-time high or near an all-time high, as it is today, I think investors are starting to embed sales expectations and profit expectations for significant new products, such as this AR/VR headset, and I think potentially over time, an autonomous driving vehicle. So I think that for Apple, you need to expect that there's going to be more than the iPhone, as wonderful as the iPhone product is, to continue to drive the stock higher, given that it's trading at near or at all-time highs.
What are you expecting to learn? We know that there's going to be the AR headset unveiled today at the conference. Is there anything else that you're looking for in terms of indications about strategy or just growth potential?
Yeah, so for me, again, the key is, what is the consumer going to do with this device? So it's wonderful to have an excellent piece of hardware from Apple, but if you don't have games to play or content to consume, then I think it's going to be a tough sell for Apple as it waits for the ecosystem to catch up with the hardware. So basically, I'm looking forward to details on what exactly does Apple think consumers are going to do with this device, especially over the next 12 months.
We're probably not going to hear too much about artificial intelligence at today's conference, but what are you looking for just more broadly in terms of how Apple will deploy it? And I think about the AR headsets as being sort of a prime candidate to possibly be some sort of foil for some new artificial intelligence, ChatGPT, that can help us in our daily lives.
Yeah, so I think Meta Platforms kind of put it best when they said that their long-term vision is the metaverse, but in a near-term vision, Meta Platforms is leveraging artificial intelligence to improve the consumer experience on Facebook, Instagram, and elsewhere. So I think for Apple, if the AR/VR headset is a long-term vision for Apple leveraging artificial intelligence, what are they going to do on a near-term basis? You think about some of the functionality they've added to their iPhones, SOS as an example, things of that nature. You think about Siri. So there is things that Apple can do on a near-term basis with artificial intelligence while we wait for this AR/VR headset to gain traction.
Tom, do you think that any of the tech giants are overpriced at this point?
So specifically as it pertains to the two that I cover, Apple and Amazon, the answer is no. I think the important thing here for Apple is that you have new product news. I think if we were solely baking it on iPhone sales and things of that nature, it might be challenging. And then for Amazon, it's certainly a slow period of time for e-commerce, and the slowing growth in their AWS business is concerning. But I do think their AWS business essentially is the backbone for a lot of this artificial intelligence efforts. And we are looking for trends potentially to improve on the e-commerce fronts as they do a better job managing their expectations. So for those two, I think there's still upside to where the stocks are trading today.
Tom Forte, thank you so much for being with us. We really appreciate it. Meanwhile, we do have some breaking U.S. economic data just crossing the terminal. Bloomberg's Michael McKee joining us now with more. Mike.
Well, we're setting up for the ISM services number at 10 o'clock. We get the S&P Global Services PMI for the United States. Comes in at 54.9. That's down from 55.1. And the composite, 54.3 from 54.5. So very little change in those numbers. And if they're any indication, maybe not a lot of change coming in the ISM Services Index, which is due at 10 a.m. Wall Street time. And Lisa, that is expected to rise a little bit. So we shall see.
Mike, thank you so much. I do think it's interesting. A downside surprise on services PMI. I mean, maybe this is indicative. We shall see. Coming up, the market moving events that you need to be watching. That's next in our trading diary at a time when stocks are reaching a bull market. This is Bloomberg. This is Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Ferro. A quick look at markets. We are seeing just up off some of the highs of the session, but still the S&P looking to get toward that 4,300 basis. Time now for the trading diary you need to be watching this week. U.S. durable goods and ISM services at the top of the hour. Then later today, Apple will have its Worldwide Developers Conference. UK Prime Minister Rishi Sunak visits President Biden in Washington on Wednesday, and we'll get U.S. mortgage applications. And then on Thursday, another round of jobless claims. This was Countdown to the Open. This is Bloomberg.